Welcome to the Achievable FINRA podcast. I'm Tyler, founder of Achievable, and we have affordable courses for the FINRA SIE, Series 6, 7, 63, 65, and 66 exams with industry best pass rates. Each Achievable course includes everything you need to pass the first time, including a full textbook, videos on key topics, thousands of questions backed by our memory enhancing algorithm, and full length practice exams. You can try it out for free by going to achievable.me, and if you like it, use the code podcast to save 10%. Now, let's get started. So, today we have Ken Finnan back on the show with us. Love having you here, Ken. Thank you for coming back.
Thank you. Love
Yeah,
being here.
and the topic today, I mean, it's somewhat timely, right? We're here, it's the end of July when we're recording this. It'll probably come out in like another month or two, probably one. But the general idea, based on the last couple of rounds of inflation data and sort of what the market is signaling with their predictions, is that the Fed will start cutting rates maybe as soon as September of 2024.
Yeah, we can think so.
And that's going to be a big deal, right? I mean, I think, what we learned at the beginning of this year is never count your rate cut chickens before they hatch, right?
Nope. I'm not even sure it's going to happen again. Who knows? Some numbers are going to come out and
Well, it's been a
turn the
couple of
cardinal
months of
shit.
consistent, like good, inflation data and things like that. So it's starting to
Right.
look like, what Jerome Powell did worked. We'll see.
Hmm.
But it'll be interesting. So let's say, basically, let's say there is a rate cut, right? And I think this is just a good exercise for people. How is that going to affect the markets and sort of like, mega cap versus small cap and things like that? And then also, how is that going to affect,
Right.
how wealth management firms approach hiring kind of going into Q4 and even Q1?
Right. Well, I think if they do cut it, the first cut will not be a massive, it won't be a big cut. And I don't think it'll be a massive impact. But the bigger firms that rely on a lot of debt, that will absolutely affect them. So we think like the tech firms are going to be great. I think they're going to be stronger. But I'm thinking more of on the broker dealer side, the wealth management side, what's going to
Right,
happen? Well, we have more volatility, right? The market is going to be more volatile. That's going to be good. There's going to be more investment, so that means people, maybe there's more underwriting, maybe there's more activity. So there's a lot more stuff going on when they start really committing to cutting the rates. Then the broker dealers and the investment banks are going to start seeing more business, more trading, margin costs go down, which means people can do more things. So then what happens? Then they have to start hiring. Okay, more traders, more research analysts, more compliance. So I think that's going to help a lot. So they will absolutely start hiring again more than they are now. Like they're sort of hiring, but it's like they're looking for the perfect candidate right now. So they're kind of being very selective, and they run you through 4 or 5 interviews. And Wall Street, the way we do it, we overhire and then we overfire, right? So I think we've been letting people go, and then now if this rates start cutting and they start trading, we need to get people in now.
right,
So you're going to see a lot of hiring come from this. The problem is that once you start seeing rates drop, we're going to make less money on interest, right? Like I have a friend who ran the stock loan department for like Bank America. I think it was like a 10-person firm, and their revenues were in the hundreds of millions. 10-person department, because stock loan for Bank America is
mhm,
massive. So they make money off interest on stock borrows and loans. So if that drops, their profit margins go down. But then people start competing, and they have to make money somewhere else. So they start what they call rate compression or commission compression, where people start, it's a race to the
mhm.
bottom. So then you have like, okay, we're going to make less money on this interest, but it's going to be a fight to the bottom who can get the most dollars from everyone. I don't know if I helped a lot with that, but I'm just thinking it's good. I think there'll be more activity and more hiring.
Yeah, and on the more
But I think the profit margins will be lower.
right, I mean, I think on the more activity front, certainly, at least, we're one of these people, and I think a lot of our friends are, where for a lot of people, it is hard to not park a ton of your like a sizable portion of your net worth, right? Like much more so than say you would in 2020 in just a high yield savings account.
Right.
because you could get
Right.
4.5 to
I
five and a
agree.
half percent very easily. So why would you
Right.
even bother, right? I mean, the S&P 500, I think the last time I checked is like up 16% this year. So you're still losing money compared
Right.
to being in the game. But like, I think a lot of
But with
money is
no,
on the
you can sleep at night.
sidelines when you are sitting on a
Hmm.
5% free money interest rate. So
Right.
that to me
Yeah.
tells me that basically, kind of like the housing market, as soon as rates start to come down, I think people are going to start to look for more productive ways to deploy their cash.
Right. Right. So they'll bring in more advisors, get more phone calls. Everyone wants to know how to handle a low interest rate environment, right? Like we've done it. We've had it for 2000, what's 8 to 2020. We had a low interest rate environment, but it's been 5 years. It's been almost 4 years since we've really had that. So, and you're right. Treasuries are attractive now. High yield savings accounts, those are amazing right now. I mean, to be able to get 4 or 5% without worrying about your money. And I think people are worried that, look, whether you like it or not, both it's a political environment too, which is crazy. And everyone wants, they're saying there's going to be a recession. They say there's going to be a dropout. There's going to be a correction. So there is money on the sideline. So to sleep at night, you put it in, you earn your 5%. You're giving up a few percent, right? Because the S&P averages around 10% a year since like 1920. You're giving up that percentage, but you're also not taking the risk of walking into a
Well,
20%
and you're fully
recession.
liquid, right? I mean, I think
Yeah.
that's the thing though, is I do think that, the consumer who has gotten a lot more active in investing basically since the GameStop days,
Yeah.
um, is going
Yeah.
to come back. I think when we get rates lowering. I mean, I was reading an article the other day
Mhm.
about how essentially, regardless of who wins the election, and we're certainly not here to debate the merits of either person on that today,
Nope.
they're probably going to be walking into a minimum of 2 to 3 years of just like green grass, right? Like there's just like we paid for the hangover,
Yeah.
right? We had the
Right.
drunk party years of 2020, 2021. The Fed printed
Right.
40% of all the US dollars currently in existence.
Right.
And everybody was flush with cash. That's why, Bored Apes were selling for six figures. Now,
Oh God, it's
right
crazy. Yeah.
now, like, I mean, I think that this is a whole nother episode, but like that was just a consequence of people literally having stupid money and nowhere to put it. Um, and
Yeah.
now, interest rates show up, party's over, hangover kicks in. We've been living through the hangover. And now the hangover is like
I
basically
agree.
just wearing off just in time for the election. Funny how that works. But then whoever
Right.
comes
It's amazing.
after is going to inherit, the sunny, I just had brunch and a mimosa and I'm feeling great market, right?
Yeah. They're going to look like a great president, whoever it is.
Exactly. For the wallet, which
Yeah.
I always believe that Americans vote with their wallet, and that was why I thought Biden would be a one-term president. Turned out it was for a different reason, but
Right.
but yeah, um,
That is another
there's a
podcast.
yeah totally different topic. But yeah, it is I think it's an environment that I think you would call largely bullish, which is interesting because the flip side is like PE ratios are back to sort of bubble levels across the markets,
Oh
right?
yeah.
Like I think like the average
But
is
what do
like
you do?
27.
They're making money. But the problem is, yes, but the companies are increasing their profits every year, right? So it's not like it's going up on its own and there's no the companies they're making massive profits. It's just the stocks are going up even faster,
Right.
right?
Yeah, I mean also if you think about it, let's say you devalue the US dollar by 40%. Just this is not that's not me having any data. That's just a
Right.
random thing I threw out.
Right.
Then the PE ratios would get 40% bigger and be effectively the same.
Right.
So maybe it doesn't matter anymore.
Yeah.
But yeah,
Right.
it'll be interesting. I mean, I think, yeah, like you said, for like wealth management in general, I think this is going to probably be maybe it might be the start of an overhire season somewhat soon. Do you think it's going to differ
Right.
by types of firms or, yeah, more detail on that?
I think so. I mean, as far as the brokerage firms, I think the wealth management is what it is, right? I think they can handle a lot of the business they have. Although, to be fair, I have a few students that come in and they're basically their financial advisor has like 1,000 accounts, and he can't watch all of them. So he lets a young person come in and go, you handle these bottom 200 for me, whatever. So I think they're probably okay. They'll bring in the lower people. I think what'll happen is you'll see a lot more underwriting business because people want to raise money and they want to invest, so they want to raise money. So the underwriting, I think, will jump a lot. The one thing I'm going to say is that I do think the only issue that when you brought up, I want to go back to that a little bit. The rates start dropping. We're seeing incredibly high credit card delinquencies now.
Right.
I mean, that's a lot higher than it's been. Even my wife, she has a Lowe's card. She doesn't use it a lot, but they just told her that if you run a balance, it's 35%.
35? I thought that it
I mean,
maxed out at 30 because
35%.
I've never seen anything higher than
Yeah,
28.
that's what I thought. No, and I go on experience sometimes and look at like cards and stuff like that, right? So I look at that, and some of those rates are like 28, 35, 39%.
I thought Elizabeth
I
Warren
mean, so if
stopped
you're
this, huh?
delinquent, I know that's what I thought. I don't know. I mean, who knows? Politicians, I don't believe anyway. But it's it's just incredible that somebody could. I mean, that's like again, that's veto in coming and knocking on your door and going, "You pay me because you put your cash in an envelope level." That's Shylock, right? I mean, 35% interest, and that like compounds daily, if I remember right. That's some crazy stuff, right? So my wife never has a balance, thank God. But it's just like that's a lot of money, and so
Well, and
you
it's no
and they're
doubt that the
delinquent. And the problem
delinquencies
is,
are
they said
going up,
delinquent.
right? Because, I mean, like
Yeah, who can
when I
afford that?
started Achievable, it was on credit cards initially, and I ran up a
Yeah,
reasonable five-figure balance, let's say, and it got to the point where the
right.
interest on that was comparable to my rent, right? And so, like, luckily I was
It's
able to get
crazy,
out of it because I went and got a job again for a minute and like was able to pay my bills. I feel
right?
like if work in service industry, work in retail or whatever, and then you ring up even call it like a $20,000 credit card bill, how the hell are you going to get out from under that?
I don't know. And that add that on student loans.
Oh, right. Yeah.
It's just imagine if you have a student loan and a credit card that's hitting 35%. Like the student loans, you can never freaking pay them off unless you lump sum them, right? The only way to get rid of them is lump sum it, and then you're looking at a $30,000, 30% credit card rate. I mean, there's no way to catch up on that. So we need the rates to drop, and that's the only reason I'm worried that even if the rates drop, a lot of this stuff is people borrowing off credit cards to create demand.
Hmm.
I'm just hoping that we can, hopefully we can drop the rates, people start hiring, and people can pay off their credit cards. But on the thing I was saying, what you were saying before, where are they hiring? I've found that almost every one of these places, other than wealth management, they're wanting when they bring people in, they want them to be able to code. They want them to have some sort of technical background.
Yeah.
Like they're not just hiring the kid. Oh my there's always going to be the kid who comes from a tier one school, and all that, and he's related to my CFO or something like that. There's always those we got to deal with them. But I'm seeing a lot more women in the force, right? A lot more women,
Great.
and I'm seeing it's great because you need you need both, right? You can't just have men. It's always been men for up until like what a year ago, right? So it's almost always men. So now that like I'm watching these like classes and I go, wow, it's like 50-55% women and guys, and that's good. But all of them can code. Not like, not like the black hat hacker, but they all can run spreadsheets and they can actually code. I guess it's back end systems. I don't know enough about it, but I'm seeing that they're asking us to do some coding or
Right.
at least to do some sort of to proof that we have some technical expertise. Because, I mean, with AI and all this, things are going to change. And
But why
every
why would
single
there be
saying,
coding in
everyone's
a
saying it.
wealth management job interview?
Well, no, not wealth management so
Okay.
much, but more on the trading side and the investment banking side. Like all the analysts come in. If they go to wealth management, yeah, they don't need coding. But here's the other thing. Maybe they do because when you're doing portfolio management, right? They want to have a back end, right? They want to make sure that if we plug this in, is it going to learn? Like I guess if you think AI, I mean, we're all going that way, right? So maybe they can adjust instead of just saying, "Oh, John is 40 years old and has this, and this in his investments. He should do this based on a computer program." Maybe the programs get better. Maybe they can learn to say, okay, he doesn't like maybe he's risk averse. Maybe we have to change things. I don't know. They're just saying, I know that on the analyst side, when they're coming out of college in those analyst groups or those summer classes where or they have tech. They're learning coding and they're expected to have some background on it, some technical expertise. Yeah, if you're an FA, you just got to make sure you can sell and you can keep your customer calm, right? That's really what that's about.
Right.
But yeah, on the other sides of it, more technical side, we absolutely need. It's all technical stuff, and that's not just now. That's been for the last 4 or 5 years.
Got it. Okay. Well, I think also like, yeah, this is maybe a good segue, just talking about like how these firms are hiring in general, right? Definitely we've noticed as early as 2017 that, the sort of the traditional, like, you gotta have major in finance thing, like, obviously
Yeah,
still applies to like investment banking and a bunch of like the, for lack of a better word, like kind of higher end, harder to get jobs in Wall Street and the entry level.
right,
But the wealth management world, which is, like the Wells Fargos and the Fidelities and the Vanguards and the Northwestern Mutuals of the world, there's way too many job openings for just those people, right? Obviously, they like to see
right,
that experience, but if you don't have it, it's no longer a deal breaker. And in fact, what they really need you to do is do sales, right? Because essentially, like,
yeah,
the days of the Jordan Belforts, telling your grandma what stock she should buy, that is a lot less
right.
common now. And what's more common now is that, you're selling the Fidelity growth tech portfolio, right? And so like that's all
Yeah,
that finance work of like what stocks to pick, like why, what are the key selling points, all that stuff,
right.
that's all done for you. You're handed a packet and it's like, go sell this.
Yeah, soft sales.
Yeah.
Yeah, you need soft skills, right?
Yeah, and so
I agree.
if are work in retail, you can actually potentially transition over to wealth management now, which is kind of cool.
Yeah, 100%. Right on that point. So about 10, maybe about 2012, I noticed a lot of my students were like communications majors, policy majors. Like, I'm not going to get the finance major in my class because they probably know what they have and they're cocky and they probably can pass the exam. But I was getting a lot of people who were alternative majors. I mean, literature. My daughter was a art history major, literally, and she ended up working at J.P. Morgan and runs a hedge fund now, right? So it's the fact that you can have a conversation outside of a spreadsheet, and you're 100% right on this. Yes, the computers can do the work and do the modeling, right? It's the person. Can you sell it? Can you explain to the customer, even if it's grandma, why this is good for them?
Right.
And you're right. I've seen a lot of it, and I think that's good. And look, historically, men have taken finance and STEM courses, and women have not. That's not a thing. It's just historically. So what's good is that they are more empathetic, and they make. And again, I'm probably going to get canceled for this. I'm kidding, but they are much more in tune to not so much emotion, but to reading people a little bit better. They're much better salespeople.
Hmm.
Yeah, the men, we can
Hmm.
come in and try to bully you over, but the women will get you to understand their point. Because whenever I talk to my students about selling, you're not selling the product, you're selling yourself,
Hmm.
right? Do you want if they can trust you, they'll buy your stuff.
Right.
So, and I see a lot of soft skills coming in, and I do think it's valuable because obviously they can have a conversation that it's not just like, oh, I'm talking about alpha and beta. No, we're talking about marketing and all the other part of your investing.
Well, right, and we're talking about the thing that I think has also shifted, and at least how I see people talk about these things. Even, you tell me if I'm wrong here, but there was like when it was sort of, so call it like the 90s or even early 2000s, it was all
Okay,
about,
yeah, you can say
yeah, it
90s.
was all about the 90s, or sorry, all about the numbers. It was all about like the alpha and the beta, and
Yep.
like this is, we think this thing is going to happen because of these numbers. And now it's like much more like I don't know how to, like like holistic. I what I want to say is it's gone the way of the coffee shop, where the coffee shop used to give you black coffee, and now it's like, would you like a lavender vanilla oat milk latte? Like it's like the same thing
Yeah,
where,
and cookies, right?
right, it's like the same thing where it's like in before it was just like, all about the numbers, all about the brass tacks, and now it's like, well, what are your goals? Well, why don't we build you like a package, a portfolio of things that will get you there,
Oh
right?
yeah,
It's much more holistic, and
100%.
like I think that maybe
Yep.
reflects sort of the little bit more feminine energy, maybe, but I think that's maybe a
Yeah.
trailing indicator. It might just be more. that's kind of how people are buying. Maybe it's how millennials are buying, right? To kind of go back to the coffee shop.
Right. Yeah. I agree. I've seen that too. That a lot of the analysts that come through, they're working on a team where they do everything. Again, for my level income, no, they don't give a shit about us. But they do care. Like Goldman for a while in 2009 got rid of anyone under 5 million, and then they said, okay, that's a mistake. They brought it back. But like UBS, if you have less than a certain amount, you get a call center. However, once you're up, you get the full
Right,
package. When you get to a certain level, they have. If you want a mortgage, we have a mortgage guy. You want us to do your taxes? You want us to pay your bills for you? We'll do it. They literally do everything, and they will make sure your insurance is done. We'll make sure that you have a. We'll help you find a nanny. We help you find the schools to get into. They literally do, and these are the ultra high net worth investors. They have a team that basically you can almost call 24 hours a day and somebody will pick up that phone. And they let you, and they do everything for you. Like, I wish I had that kind of money where I could just have somebody pay my bills for me and I never had to think about it.
right.
And it's a nice, and it really is, that's a package deal, and it's a good moneymaker for the firms or they wouldn't do it. I mean, they're sitting on, you have one advisor and has about 9 people on their team who don't maybe bring in a couple customers, but they're really there just to support the customers.
Right. Well, and also, I mean, if I think the for me at least, when you said that, the key thing that I thought of was like that's great retention, right? You don't want these guys to leave.
Yeah, oh yeah, you can't
So
leave.
if you make it
Right.
really, if you make their life really easy, and also if they left, very difficult, that's a good way to do it.
Yeah, and they're bringing other assets from other firms. Like their entire job is say, "Oh, you have money at J.P. Morgan and UBS and RBC. We'll bring it all over here. We'll lend you money." And that's the other thing. The whole thing about lending money, right? So instead of taking capital gains, these are the firms that will lend you money based on your assets. And you get a better rate at J.P. Morgan. Bring it all over, and they get it on this, and they're poaching from other firms.
Right.
Whoever has the best all-in package. I think that's the way it's going to go for a lot of people.
Yeah, well, right. And also like again, because you don't want to pay taxes on your $1 billion in
Right.
stock if you're some billionaire guy.
Right.
Getting
Yeah.
a loan to basically have cash flow instead works out really well.
Yeah. And almost never have to pay it back.
Right. Yeah.
I still have to wrap my head around that a little bit, but it's just like that's what they do. I mean, and, and it's look, if you have it that way and they're working on it and they're doing that for you, why would you go anywhere else? Like you just said, absolutely. If my life is easy, why am I going to upend it to go somewhere else?
Right.
I'm not moving. I'm staying. And my people know me. They know my name. They know my kids. They know my dog. They know where I am. They know if I need something. If I call them from Greece, they're helping me out. Oh, we'll wire money to here and we'll get it for you. I mean, that's nice having like a central hub who can take care of all your stuff for you.
Yeah, absolutely. Well, yeah, I think in general, just it's becoming more of a services industry. It's becoming more of like a
Hmm.
people industry. And then
Yeah.
I think, as for better or for worse, like millennials are starting to get into their prime investing age range, right? And I
Yep.
think there's probably a lot of
Yeah.
millennials who would like to do that and aren't really, right? I certainly like to be doing a
Right.
lot more. Like I have some friends that are much more involved in the market than I am. But
Right.
it's very much, I think, like gonna be a good season for the wealth management world.
No, no, I think so.
Yeah.
Yeah. The only thing I worry is that if they at some point technology is going to come in and it's going to shrink a little bit. But I think wealth management. I think there's no way to shrink that
Well, again, we
because
just
somebody's
talked
going to
about
answer the
why,
phone, right?
like
Yeah.
AI cannot be somebody that makes you feel like appreciated, right? Like
Right.
AI
Yeah.
can answer your customer support question, but even if they do a great job, you're just like whatever, you're a fucking bot, right? Excuse my language.
Yeah.
Like
If I have
you
$50 million,
don't
I don't want to talk to AI, right?
right. Well, and more importantly, like even if you have, $1 million or whatever, right? Like even if you're not in that high net worth bucket, you
Right.
still like you said, like the broker or whoever, sorry, the advisor, they're selling themselves, not
Right.
not like the
Yeah.
stock or whatever. Because at the end of the day, like
Right.
how different are the mutual funds of these different companies? Like probably not that different. They probably overlap,
No.
I would
No
say at
difference.
least 50%. That's super conservative. It could be as much as like
If not
90.
more.
Yeah. Like they
Yeah.
overlap so
Well,
much
that's
because
why they
there's
don't
only
let you
so
put
many
in multiple
stocks.
funds. Yeah. They all do the same thing. Yes, there may be a 1 or 2% difference in alpha of one advisor over another, but it's not a big deal. That's why you can't be in multiple funds, right?
Mhm.
That's why you can't put one customer in Fidelity and T Rowe because there's not enough of a difference to justify the extra
Oh
fees.
yeah. No, and so therefore, an AI telling you we think you should get, Vanguard, whatever, like you don't build any
Yeah,
relationship there. So I think wealth
right.
management will hopefully kind of get through the AI phase relatively unscathed, right? Like not there are
Yeah,
definitely other
I
parts
agree.
of it. Like I think paralegals are in deep trouble. I think I
Yep,
think like things
I
like
agree.
quality assurance is in a lot of trouble. Um,
Stenographers, yeah. I mean,
yeah,
anyone who's right just taking notes, yeah, it might be an issue.
yeah. But for
I agree.
our good friends who are advising clients on their wealth, I think that they'll be okay. Is
Yeah,
there anything that when
I think it's on the business side.
yeah, I was
Yeah.
gonna say, is there anything as we're kind of like wrapping up here, is there anything that you came in wanting to talk about that I haven't asked you about yet?
Not really. I mean, the only thing I wanted to say is I wanted to bring this up about on the advising side.
Yeah.
Everyone I've seen is that there's a major gap, and I've said this a couple of times to people. There's a lot of young advisors starting in the business, but there's a ton. I mean, I don't know what the average age is, but it's over 60.
Mhm.
I mean, if you take away the 20-year-olds, right? They're all 60, 65 years old, getting older. Obviously, they're getting older, but they don't have anyone to pass their business on to. So there's a gap.
Mhm.
There's a real need for experience or at least advisors to come into the business. So they're hiring definitely a lot and training them. Like I have with New York Life and Mass Mutual, I'm well helping them out, and they're bringing people in knowing. I mean, they're bringing a lot. I mean, like my classes are 40, 50 people each month. They're bringing, and that's just one office or one area because they know there's a major gap in the middle. And you look, I don't care what it is. Gen Z and millennials do not want to talk to a 75-year-old person. Like it or not, they don't. And they may vote for a president or not, but they don't. Okay. They want to talk to someone who's their age and understands them.
Yeah, but that's like the whole point of sales is you got to be uncomfortable if it's the right thing to do.
Yeah. No, I understand, but I understand that. But what happens is you get the older guys, and I like the older guys, but if they're in their 60s and 70s, I mean, they don't, I don't even know. I just think there's a major gap, and the firms are worried about it because when these guys retire, you're going to have a bunch of 24, nothing wrong with 24-year-olds, but they don't have the experience.
So, you're basically saying that there's a bunch of like people who've been wealth management advisors their whole careers. They're making good money. They've had the same accounts for 20 years. Like there's those guys, right? They're the vets.
Yeah,
They're not going anywhere. Or, the worst thing they're going to do is like spin off to start their own little private firm. Um,
right.
the and then there's basically like a huge gap. And then there's all the entry level people that are getting in because they want to be those old guys in 30 years,
They
right?
see the
Or at a
money.
minimum,
Yeah,
they just want to
yeah,
have a higher paying job than being at Zara. And it's
right.
so what happens? Where's the gap come from? Why aren't there 30-year-old, 40-year-old wealth managers right now?
I don't know. I wish I knew. I don't know if they left the business or they didn't hire enough. I mean, for the last 10 years, these firms were not doing it right. Where they were bringing people in and going, here, we're going to pay you 60 grand a year. You need to bring in $30 million under management in the next 3 years and have at it. Now they're starting to say, okay, we bring you in, we put you on a team. You're with an older advisor who's going to teach you the business.
Right.
And then maybe when he goes, he's going to get, or like I said before, they'll give you a piece of their business so you don't have to sit there be selling all the time. Because who's going to give a 22-year-old, $1 million? Nobody, right? And they know that. So I think their 95% fail rate through the 2000s and 2000, probably till the 2020, created a massive gap. I mean, because think of it, if that worked in 2000, those guys would be in their mid 40s and then be good,
Right. Yeah.
right? So if you didn't, right? So that's what I'm saying. When they screwed it up 20 years ago, and I remember we all talked about, oh, they'll pay you 60 grand a year in 2008 for 3 years. All you have to do is get $10 million under management. That's not easy, especially in 2000, 2005. It wasn't that easy. Now it's 30 million, 40 million. And you can't live off that. I know it sounds crazy, but if you have 30 million under management, you're not making that much money.
Mhm.
You're maybe making 80 grand. I mean, not that it's nothing, but in the business, making 80 grand a year and living in the city all the time is not, you can't live on that.
Right. Which is
So
why
I
all
think
the
that's
all
what
the
they screwed
sharky
up.
people, go to investment banking or
Yeah.
whatever. Yeah.
I'm trying to convince. I have a student now. I'm trying to convince him. He's in wealth management. He just hooked up with one of the top teams at one of the top teams at J.P. Morgan. Former First Republic guy. Now they're at J.P. Morgan. He's a master producer, and he's with them. And he really wants to get an IB because he sees the money. Because he wants to go to a PE firm. I'm like, yeah, that's great, but that's you have no life, right? As my daughter said, oh, the IB people. They're the guys you walk past them. They're just on spreadsheets all day long. Like you don't even know what they're doing, right? It's not a fun life. I mean, some people like it, and if you don't get a PE job, you become a VP or an MD of a firm, and you're literally working 7 days a week.
Mhm.
And the FA life, I'm telling you, once you get it down, if you can get past the first few years, it's a nice life. You have normal
Take
hours.
your
You may have to go
clients
out to dinner a couple
golfing.
times. Yes, yes. I, you go away, you can go on vacation because as long as you have a phone, you can talk to them. They don't care where you are. You can live in Florida and all your clients are in Idaho. Who cares? But you're an IB. If you go more than 90 miles away on a weekend, you got to get permission first, which is a not. I'm not lying about that.
Yep.
So
Yeah, I mean
there's a
my
gap.
my wife's brother did IB for 2 years, and we'd like plan a weekend ski trip, and then like basically we'd already be on our way driving up, and he'd call and be like, "Sorry, I got put on a project. I have to stay behind." Right? Like, and that happened like
Yes,
3 or 4 times,
yes.
and I think we planned 5 ski trips. So it was
Never could
constant.
go. No, it's scary. On the same note, my daughter had a friend worked at Deutsche Bank. Um, she was in IB, and they were out a Fourth of July weekend in the Hamptons. And also, I mean, this is a weekend. She gets tapped on the shoulder and goes, "We got to go. There's a car waiting for us. We're going back to the city." Like there, and it was like on a Saturday. That's why they had to create a thing called protected Saturdays, which is a joke.
Which
Like you
aren't
can't book
protected
on
anyway.
Saturdays. Oh my God, they're not protected at all. It's literally 7 days a week. So I don't know. I mean, that's why you see the people getting sick and they get hurt. And some guys, they don't do good things to themselves because I'm not going to go into that. But there are people dying from doing this because of the stress, because they think they have to keep doing it.
Mhm.
And there's no end to it. It's not like you go to the PE firm, the Holy Grail, and your life gets easier. You're just doing it more, and you're on the buy side versus the sell side.
Yeah. Well, so
Look, and people do it, and you can make a lot of money doing it.
yeah. Well, in any case, I think for a lot of people, they're not even worried about getting to that area of Wall Street. I think they're probably more
Yeah,
like trying to get into Wall Street at all, right? Which is where I think this
right.
upcoming sort of season, call it 2, 3 years of the
Oh,
wealth
I think there's
management
going to be a
world,
lot of jobs over the next 2 years.
yeah, it's going to be really
Yes,
good.
compliance, tech, back office. Back office won't be as busy as it used to be, but it's going to be there. And the advisors, they're going to need people to answer the phones. I think you're 100% right. If they start dropping rates starting in maybe February, March, you're going to see a lot of hiring.
Yeah. Yeah, it's going to be really
I
good.
think so, and that's a good way to get your toe in the door, right?
Yeah, and that's the other thing too, is like you said, there's this real like bench problem that all these firms have right now. So if you're, even in your 30s and you're like, you know how to work, you're a good employee, but you never really
Right,
considered finance. Maybe you worked in tech sales, right? Maybe you worked
right,
for like a lumber yard being the foreman or something, right? Like, but basically like you had like
right.
a real job, like you
Yeah,
can cross over to finance potentially, and
yeah.
there is a dearth of competent 30 and 40 year olds at the moment. So
Such a
and
talent
and
show. It's
also if
great.
you're in if you're in your 20s and you do a good job, you can grow into that. So it's definitely a good
You can
opportunity.
stand out. You can absolutely stand out. If you're a hard worker, you can, because a lot, look, every generation calls the generation after it lazy, and I get that. But, and I'm not saying they are, but if you work hard and stand out and have good grades and all that other stuff and get the licenses before you get as many licenses as you can before you start, which would be great with your program,
Right.
um, I think you can get a job and really excel.
Yeah.
Because a lot of people worry about their emotions, and it's, if you can suck it up and take a little crap, and not worry about if somebody insulted you or not, you can go really far.
Yep. Yeah. And also, frankly, like, um, if you basically are willing to put in a little homework ahead of time, like you said, like I basically think everybody that applies to wealth management jobs should get the SIE first because you're gonna have to do it anyway.
100%.
And it
Yeah,
also is kind of a good litmus test for you to be like, do I actually like this stuff? And
right.
can I pass these licensing tests, which, call it 15 to 30% of people, struggle with at each step of the way.
Yeah,
Right. And
yeah.
if that's really hard for you, it's not going to get any easier than the SIE. The SIE is the easiest.
Nope.
If the
Yep.
SIE is like, yeah, I mean, I took the SAT and this was kind of the same. Yeah, you can probably get your 6 or 7, and you can probably eventually get your 63, 65, 66, and it's not going to be
Yeah.
something that could
And you can
derail
do
your
them before you
career.
start working anyway.
Right.
Like, you can even do them before you start working too. Then all of a sudden you have one test to take when you start versus three. It's a no
Yeah.
brainer.
But the SIE for sure, especially because like a recruiter
Yeah.
will look at that and be like, okay, you're committed, right? You
Yeah.
you spent 50 hours and call it like $200, whatever, like a prep course plus the test taking thing costs. And you have proven to me with this certification that you really care. Like that's actually pretty
Yeah.
cool.
On your own.
Yeah, on
You
your
did
own.
it on your own without somebody telling you to do it.
Yep. Yeah. So in general though, I think a lot of opportunity out there and really yeah, like I said, we'll see kind of how when the rate cuts come, but assuming wheels don't fall off between when we recorded this and let's call it like February 2025, it'll probably be
Right.
sometime in that range
Yeah,
the
I agree.
consensus at the moment. Of
I think this is
course,
a good time to be in wealth management to be looking into it. 100%.
yeah, great. Well, thank you so much. This has
Happy
been
to do it.
Yeah, this has been Achievable's FINRA podcast, hosted by Tyler from Achievable with Ken Finnan from Capital Advantage Tutoring. You can also look him up on YouTube. He has an awesome YouTube channel. And Achievable has great courses for the FINRA SIE and the Series 6, 7, 9, 63, 65, and 66. You can try any of these courses for free by going to achievable.me. And if you like it, be sure to use the code podcast to save 10%.